Welcome to the Krona Correction Series in association with Refinitiv. I'm your host, Roger Hirst. Gold has been one of the biggest consensus trades over the last few months. And although contrarians could argue that the trade is crowded, gold and other precious metals have still not disappointed, despite the recent pullback after gold had surged to a new all-time high of over $2,000. Cameron Alexander, Refinitiv's Director of Precious Metals, summarised the key drivers of gold and silver, outlining which markets, such as physical or financial, were powering the moves in this space.
Well, yeah, but we've seen gold absolutely take off in the last month or two. We've seen gold just in the last, in July, up by some 12% and up 30% for the year. So it's quite extraordinary. If you go back to when we spoke last in April, gold at that time, we'd seen a bit of a rally on the back of the first sort of understanding of what the pandemic meant for the world in terms of the financial markets. And at that time, the US dollar was actually quite strong. And we saw a bit of a rally in the US dollar around that period and sort of in March, April. Since then, we've seen the US dollar come off quite a lot and losing sort of 8% since that March high. And really now at a 2-year low. So that's one reason why we're seeing gold prices in sort of the last recent weeks or so really start to accelerate. It really has been a very uncertain time, on the economic front. Obviously, COVID has been a big impact right through the financial markets. We've seen the US economy really start to falter. And I think that's one reason why we're seeing a lot of investment demand for gold. We're seeing investors starting to sort of perhaps review what they're holding in terms of their asset mix. And we're seeing a bit more money flow into safer assets. And gold is obviously one of those. We're seeing very strong ETF demand for gold. In the first quarter this year, we saw some 300 tons of fresh inflows. And in the second quarter, saw 436 tons from our estimates. And so we're taking total holdings of net ETF holdings now to well over 3,600 tons. And that's an extraordinary level. And if we can continue this kind of trend on for the remainder of this year, we're certainly going to be at record levels by the end of 2020. So we're also, obviously mentioning, strong ETF flows, but we're also seeing very strong gold futures trading at the moment, and that's also supporting the price. There's a lot of interest from investors, really just betting on the US economy slowing, and we're going to see a continued weaker US dollar. On the physical markets, we're seeing quite a contrast actually. On one side, we're seeing obviously the COVID impact has been extraordinary in the second quarter. And look at China. We saw China in the first quarter. They really felt the pain in that first quarter with their sort of fabrication down by more than 40% during that period. But the pain was really felt in most markets in the second quarter. And if you look at jewelry fabrication, for example, that was down by more than 50% in the second quarter on a global level. China, as I said, in the first quarter, their jewelry fabrication was down by some 40%. And they saw a very strong recovery in the second quarter, but they were still down by 19% compared to last year for the same period. Markets like India, for example, were absolutely decimated by the COVID lockdown. And really, they would lock down from the end of March right through until right now. They're still in lockdown at the moment. So fabrication or retailers and fabricators have been shut this almost entire time. So it wouldn't surprise you to hear that Indian fabrication was down by over 90% in the second quarter. And that's quite extraordinary for a market like India, which really does revolve around the gold market. Also, we talk about industrial use for gold as well, electronics and those kind of things, also heavily impacted this year due to COVID lockdown. And also a lack of consumer spending by the consumers, as they're now very concerned about what the future might hold in terms of employment opportunities and where the economy is going. So we're seeing quite a massive reduction actually in the amount of retail spending in most key markets. So that's also having quite an impact on industrial demand for gold, which is down by some 16%. In the first half of the year. Bar demand has also been very mixed in several markets. Western markets, or the industrialized markets, have been very strong. We're seeing incredibly demand in the US markets and across Europe. But in Asia, it's quite different. We're seeing a lot of profit taking in some of these price sensitive markets. So markets like Thailand or Indonesia or Singapore, people who bought gold at much cheaper prices are taking advantage of these record gold levels to take profits. We're seeing quite a lot of gold come back into the market. So markets like Thailand or Indonesia, for example, are sort of now net exporters of gold rather than taking bullion in as they would have done in the past. Now, places like China, we've seen obviously a strong equity market, and that's also to a certain extent pulling away some of those funds that might have moved back into the gold space. So I think if you look at mine supply. I mean, I talked about, this last time, that the potential that there was concern that, we might see a few mines shut down due to COVID. And that's exactly what we saw. We saw right across, the metal space for gold mines, PGMs, and also silver production. We saw a lot of mines basically shut down for a period of weeks. I think our numbers suggest there was over 130 mines that were shut down at some point over the last 3 or 4 months, which is having an impact on some metals. One area that's been driving the market over the last few years has been central bank activity, and this year we've seen quite a decline in purchases from some central banks. The last few years we've seen the Russian central bank being very active, and in fact being the largest purchaser of gold. But since April this year, they've been absent from the market and have not purchased anything at all, according to IMF data. So with Russia absent and also China not buying at the moment, we expect to see quite a decline this year in central bank activity. But on the flip side of that, we are seeing much stronger investment demand, and so that will easily offset the decline in the central bank activity. We are in a perfect storm for gold. We're seeing obviously the concerns over COVID. There's a slowdown in the US economy and also other key economies globally. At the same time, we're seeing that weaker US dollar. And on the back burner, we still have the trade tensions with China really just simmering away. And as we get closer to the US elections, we're down to 93 or 94 days away from the election. We might start to see those tensions with China start to sort of come back to the fore. At the moment, we're expecting to see the current sort of monetary and fiscal policies to remain supportive for gold over the next few months. Bond yields and short-term interest rates are going to stay very low on a nominal basis and in negative terms on a real basis. So these really are going to flow into higher gold prices in the coming months, in our view. It's also probably worth just touching on silver while we're in the precious metal space. And silver really has taken off in the last couple of weeks. And if we go back to last year, silver really wasn't the investor's friend at all. I mean, we saw silver really sort of languishing well below gold, and we saw the silver to gold ratio blow out to well over 125 to 1, which is sort of unheard of territory, really. And the silver sort of taking off in the last few weeks has seen that ratio come back down to sort of the 80 level. Still well above the historical levels, around sort of the mid-60s. In a bull market, silver tends to outperform, but in a bear market, it tends to underperform. So, I think in silver investors, you need to be, you could have a very intestinal fortitude, because it is going to be a rough ride up and down. And it's becoming, from the terms of fabrication demand, we're seeing very strong investment demand. And for coins and bars, we're seeing a shortage of metal in a lot of retail space, particularly in the US and in Europe. If we can't get COVID under control and the pandemic continues to evolve the way it's going, and the economic stimulus packages the governments are having to spend, it's going to create, I think, a further chance for a weaker dollar. And under those circumstances, gold really can continue to push higher. We've gone so quickly, so fast for gold, and so I wouldn't be surprised if gold prices just pull back a little bit in the short term. I think our expectation is that gold prices will sort of sit around that sort of $1,850 to sort of maybe $2,100 level over the next year or so, with the potential for a breakout if things worsen through COVID.
The demand for gold has been primarily driven through financial assets such as ETFs and futures, with physical Asian retail demand having been severely impacted by the lockdown. In fact, many in this region were actually selling to take profits as the rally unfolded. Demand for Refinitiv data on gold has picked up in all regions, with the biggest relative increase coming from Asia, especially from Hong Kong and Japan. This regional increase may reflect the activity on both sides of the market that Cameron identifies. For silver, the recent spike may still be in its infancy. Prior to the move, the only user group showing a significant increase in data usage were hedge funds, suggesting that other investors may have lagged the move. Whilst Cameron identifies weakness in the US dollar as a significant driver of price, the dollar is now relatively oversold, but uncertainty will remain into the US November election. Prior to that, Cameron expects gold to carve out an $1,850 to $2,100 range, though significant upside risks remain if the corona crisis continues to hold back the global economic recovery. So despite the recent setback, the gold and silver consensus trade should still continue to be a crowd pleaser. We'll see you later with another update.